Good afternoon and welcome everyone to the RealNex Webinar Series. I'm Jeff Finn, CEO at RealNex, and we have once again Dr. Jeff Fisher, our head of data and research. As always, Dr. Fisher will bring us his latest findings based on research that he's done in conjunction with NCREIF, as well as other data that he's been able to assemble from experts throughout the country and the world, and as they have outlooks for what's happening as we move into 2021. Obviously, an interesting year that we just finished up, and amazing that we're 1 year into this and have seen the round trip that we've got. It seems like after a very difficult V in the middle of the year, we're back to some level of recovery, Jeff, and we'll see where we head from here after that quick bounce back and some of the strength that we saw return to the market, and in some cases just continue on throughout the year. So we look forward to hearing your remarks and perspective, and as always, we'll have the mic open, the question box open for your thoughts and any questions that you have, and we'll tee them up for Dr. Fisher at the end of the program. We'll go about an hour as always, and throughout the program have a few polling questions, so be ready to share your thoughts and ideas of where the market is and where we might head as we move through the rest of 2021. So before we get started, wanted to just do a quick overview for those of you who aren't aware and as familiar with RealNex. We'll share a quick video. We've released a great new generation of the RealNex platform at the end of 2020, and just have had tremendous response to that in the market. And as we move into 21, we have another new release coming out with great new features for video marketing, email campaign management, and listing syndication, as well as enhanced presentation management tools for all of your flyers, brochures, offering memorandum, and other marketing materials. So quick overview, then we'll get right into the program.
You are going to love the extraordinary new generation of RealNex, RealNex Navigator. RealNex Navigator is a tremendous advancement of our vision to deliver what the industry has been asking for, a complete, powerful, end-to-end commercial real estate solution at an unbeatable price. Ideally suited for the current business environment, we save clients an incredible amount of time and money by providing all the capabilities needed in one comprehensive offering. CRM, a custom-built relational client and asset information management system that takes the guesswork out of prospecting, business development, and deal management. Presentations, an amazingly simple yet powerful engine to quickly and consistently create beautiful custom branded flyers, proposals, offering memos, opinions of value, and more. Analysis, evaluate deals and new offerings in minutes. Swiftly compare leases, including accounting implications, and effortlessly include the outputs in your presentations. Virtual deal rooms. Run an efficient deal process by leveraging your CRM groups to invite participants, drag and drop folders to instantly populate and structure content, and use the 7 levels of security to control access, all while tracking detailed activity. Listings. RealNex Marketplace is a dynamic community to market and transact, list, search, post needs and wants, even send and manage email campaigns. Your first 1,000 messages are free. Transaction management. Use our digital tour book and online lease negotiation capabilities to collaborate with clients, advance deals, benchmark lease proposals, and easily track activity and progress. Individually, these are each market-leading solutions. In combination, they make RealNex Navigator the most powerful, cost-effective solution for you to dominate your market and become as successful as possible. The sensational RealNex Navigator is designed to work for large enterprises, companies, teams, as well as individuals. With a robust license management capability, you can ensure ensure that each team member has access to what they need while privacy and security are maintained as desired. The RealNex Navigator delivers a whole lot more for a whole lot less. Take a deep dive demo of RealNex Navigator or sign up for a risk-free trial today. You'll be glad you did.
All right, so thank you all for joining us. Looks like everyone's in the room now. We are ready to move into the program. Let me turn it over to you, Jeff. I'll change presenter. And, as the country is getting out of its deep freeze, the question is, Jeff, how is the market doing? Is it recovering or headed for colder weather? What's it looking like?
All right, we'll get into that. Let me put this in full screen. Can you see my
You are good.
screen? Okay, all right. All right, so thanks for joining us for our quarterly commercial real estate market update. I've subtitled here a V-shape so far, as we'll see as we get into the charts. Quick disclaimer, just giving my personal opinion on all this. Your crystal ball may be better than mine, but here we go. So we do have a V-shaped recovery so far. At least if we look at all the property types combined, we're going to see that may be a little bit deceptive because there's a lot going on as we drill into the different property types and different locations. But during the midst of COVID, the second quarter of last year, we had that drop in value, not a real bad drop, but minus 1.5%. We'll see that differs quite a bit from what happened in the public markets here in a minute. But since then, we had a positive return, both this most recent quarter, the fourth quarter of 2020, as well as the third quarter. For the year then, that gave us a quarterly unlevered total return of 1.6% for the NCREIF Property Index, which is an index of the performance of properties that are held by the institutional investors. It's getting close to $1 trillion of properties, about 10,000 properties held by all the largest investment managers in the country. The REITs during that same time period, the NAREIT index was a minus 5.1%. REITs did recover near the end of the year, not as much as the S&P. We'll see that on a chart here in a minute, but REITs did have more of a drop, and overall for the year didn't get back their full value. Farmland, interestingly enough, did pretty well, 3.1% on a quarterly. Well, actually, that's on the annual basis for the year, and then the S&P 500, 18.4%. We all know that the stock market keeps hitting new highs. Real Estate Research Corporation is still forecasting a continuation of that V-shaped recovery. As you can see here, we've got the V-shape in 2020 and continuing upward through 2022. Again, for all property types combined, so hopefully that's what happens as we just have a continued recovery. As many of you know, there was a lot of talk early on about, is it going to be a V? Is it going to be a K? Is it going to be a W? What's it going to end up looking like? And maybe it's more of a K for the overall economy with winners and losers. And actually, maybe that's even true if we separate out things by different property types. This takes a look across not only the NCREIF index, the NPI. Off to the left is the NCREIF Property Index again. The ODCE is an index of the actual funds as compared to the properties that are in the funds. We don't need to drill into the details of the differences, but you can see the contrast here between what happened with properties again, but over 1 year, 10-year, and 20-year time periods, as well as the most recent quarter for the properties on the far left, and then the S&P 500 and NAREIT. You again see the minus 5.1% for the year for NAREIT, although for the more recent quarter, we ended up with an 8.1% rate of return for the REITs. Maybe I should have added Bitcoin to this graph. Being new highs, I think, in Bitcoin coins again today. This compares what happened in the property market at the top, using again the NCREIF property index data. There actually is an index that's produced that has daily returns, believe it or not. It's only produced on a 30-day moving average basis, but it's consists of those funds that are for defined contribution plans where you can put your money in or take it out on any given day. So they actually do have an index of the performance of the funds on a daily basis, and you can see how it dropped down during the shaded area there of COVID, but only a minus 4.3% overall, whereas the REITs dropped by 42%. REITs then recovered by 47%, but as you know, mathematically, it takes a bigger percentage to come back up to make up for the losses, since you're working off of a much smaller number. So the REITs still aren't back to where they were, and the private market isn't quite back to where it was either, of course. I just actually added that dashed line this morning to kind of see, well, that, you know, we ended up that they both probably ended up back about the same point as where they started back in January 2019. It's just that the REITs went through much more of a decline and then more of a recovery. I guess the question would be what really happened in the markets. Some would argue that minus 4.3% isn't really capturing what happened. That maybe because that's an appraisal based index, maybe because appraisers didn't really have the price discovery, the transactions that they would like to see, that it was hard to know how much to write down properties. They did the best they could, but you know, maybe the true decline was more than that. On the other hand, I think the REITs tend to overreact. They're publicly traded, and you know, the people that are day traders and in and out quickly sort of panic and take their money out, you know, when you don't know what's going to happen, and put their money back in. So I suspect the truth is somewhere in the middle, maybe closer to what we saw in the private market. Maybe it was more of a drop than the -4, but I don't think private equity, and I suspect if we surveyed, you know, the group just on that question, I suspect most of you don't think that overall, all property types considered, we had anywhere near a 42% drop in value. I don't know, Jeff, bring you in quickly. You haven't heard anybody that acted like we had that kind of a drop in values, did you?
I haven't seen it. It certainly haven't seen any trades like that, but people that may have felt that in hotel or other certain asset classes have been holding on to the other side.
Well, we'll get to hotels here in a minute.
Yep.
Yeah. This I think is interesting. We've looked at a chart like this in past webinars, but it shows a decomposition of the return. In other words, what is it? NOI growth? Is it cap rate changes? Or is it cash yield that's contributing the most to the rate of return through time? And you know, it varies a lot through time. You can see, you know, starting in, you know, after our tech bust and 9/11, it was really cap rate compression that helped us. But then during the Great Recession, cap rates were going up, hence the red lines in this chart going down, because the cap rates going up was hurting our returns. And you can see how much returns went into the negative territory during that recession. But then we had cap rates really helping us as interest rates fell for quite a few years, until that, you know, those red bars kind of went away, except they came back over this last year. Interest rates came down again, although I think most recently, since the end of the fourth quarter, they're pushing up back up a little bit. But the cap rates did help us for 2020 in terms of cap rates dropping. And we'll see that in a little bit more detail on a cap rate chart later on. This kind of shows the same thing, where if we have an index of what happened to market values going back to 2000, the red line, and then starting at the same 100 starting point for the net operating income, how it's increased. The market values and the net operating income were both impacted by of course, the recession. As you might expect, market values impacted much more than income that you can get from the properties because of the leases, but you also see the downturn that we have in the net operating income, the green line, over this past year, whereas we do see a turnaround in the market value index, with market values going back up again, not quite to the peak they were, but pretty close to where we started. Now we break it out by property type, and you can see kind of a continuation of a story that we've had for quite a few quarters now, and industrial just continues to be the best performing of the sectors. Of course, read that as warehouse space. Amazon just keep adding more and more warehouse space. Had somebody on a call yesterday from Duke Realty, and they're just really busy doing warehouse space for Amazon and for others. So you look at that, 4.5% roughly, just for the fourth quarter. Multiply that by 4. You're around 17-18% rate of return on an annual basis. Go out and get a loan at 3-4%. You got a hell of a rate of return on warehouse. And when you survey the institutional investors, they say they don't see it slowing down, at least for a while. You think at some point supply is going to catch up with the demand, but they continue to be pretty optimistic and think that's going to be the best performing sector. Hotels, of course, really got killed with COVID. I guess you could say they improved, but that just means less negative for the fourth quarter versus the third quarter. So there you see the -4, almost a -16% rate of return just in that one quarter, and a little bit better this quarter. Apartments kind of working their way back up again, 1% return for the last quarter. I think the overall outlook for apartments is pretty good. Big question is office. I still don't think people have figured out whether we're going to have people end up going back to office space. Some companies will, some companies won't. I know Salesforce.com recently announced that it's up to the manager, but if the manager of any of the departments wants to have all the employees continue to work from home, that's an option. And you hear about other companies that are doing that, especially in the tech space. Those companies that do return back to the office, probably going to want more space so they can spread out more, less congestion, less shared space. So I don't think we know yet how that's going to balance out. I just hear arguments on both sides on that. Retail, it really depends on what subtype it is. We're going to drill into that a little bit here on some later slides, but hard to be real optimistic about retail, although there's always opportunities in every market. And maybe it's oversold in certain cases, and you know how to reposition the space, make a lot of money. Real Capital Analytics, RCA, also tracks what's happening on every property over $2.5 million in the country. Good friends of RealNex, and they're showing pretty similar story. I show this just because it's drawing upon a wider group of properties than the NCREIF data, which is just your larger institutional grade properties, where again here everything over about $2.5 million. So, but similar story, and industrial doing well. Here looks like they're showing a little bit better performance. In this case, it's a performance just of price changes, year-over-year price changes, but apartments held up very well. Office, kind of like with the NCREIF data, looks like it's come back this last quarter. Retail still heading down in terms of the prices in the properties, followed by the Real Capital Analytics. This would be what they call repeat sales index, so it's based on repeat sales of the same property. And then looking at it by property type in the NCREIF data, you can see the apartment, industrial, office, and ugly looking retail in this chart, with it down on an annual basis. The NOI growth in this case on an annual basis, -19%. Now, some of that would be because rent wasn't paid during COVID, and maybe that rent is going to be collected in the future. I know a lot of leases were renegotiated where that deferred rent will be made up in the future. So it may be that the drop wasn't quite as bad as reflected here in what NOI was actually collected. The NCREIF data is based on what net operating income is actually collected. Comes out of accounting systems, so it's not survey. It's what was actually collected. And of course, a lot of people, especially retail, weren't paying their rent during COVID. So we'll have to see how that all ends up sorting out. All of the NOI growth categories were down, all property types, not too surprising there. Even industrial down a little bit. Investor preferences have been shifting. This starts with the financial crisis as the far left bars, the darkest green, then goes to 2019 and then more recent COVID time period. Some data compiled from Real Capital Analytics, again, from the folks at CBRE research. And you can see how, again, not surprised, but you see a similar story in all this. Industrial just jumped way up in terms of the investor preferences, where the transactions are taking place, the interest in investing. Apartments held up pretty well. It's down just a little bit. The retail, of course, keeps dropping, and hotel really dropped. No surprise there. And office down, although not quite as much down from the 2019 level. Big drop though from what we had right after the financial crisis, where a lot of the capital was flowing into the office properties. This is just giving you an idea of what's also happening with REITs. Got this from Green Street that follows REITs and the implied pricing of REITs in all these different categories. NCREIF isn't able at this point to break out the data in some of these areas, although there's a lot of interest. I've been getting people asking, can we tell what's happening with life science properties? Although it's sort of hard to define what that is. Could be lab space, could be office space. Really depends, I think, more on the tenant. But anything life science oriented, people are interested in. You can see, that's the number one here, 3% increase in values implied by the REIT prices. Data centers, a lot of interest in data centers right now. I think there'll be more and more demand for data centers. Self-storage has been doing well. Cold storage is slightly negative, but that's of course needed more and more for the vaccine. Single-family residential. I know the institutional investors are submitting some data on that to NCREIF, but we haven't been able to separate it out yet. But institutional investors have an increased interest in single-family residential properties. They've been able to use technology to better handle large investments in the single-family residential area, and then in industrial warehouse. And you can see as you kind of move off to the far right, malls at the furthest end hurt the most. Next to last, office, before that apartment, etc. Also, kind of what I was saying in the last chart, just an increased interest in what we call investing in alternatives outside of your main property types, the office and industrial, multifamily, and retail. So more and more interest, as you saw, kind of implied by what's happening with the REIT prices, into cold storage. Interested that parking is there for a while there. Everybody was talking about the demise of parking with the driverless cars, and now it's like, well, maybe we're going to need more parking because people are not going to want to use public transit to get back to work. They're going to want to drive their own car, and maybe there's actually more of a need for parking space now than we've had in the past. So kind of interesting to see what's going to happen in that area. Cold storage, again, self-storage, data center, student housing, although a lot of universities are still allowing classes to be virtual in some cases, or a combination of virtual and on campus. So not as clear to me what the recovery is going to be in the student housing area. Healthcare, of course, is a lot of interest in healthcare, medical office. Senior housing, I'm not sure how that's going to end up sorting out. This gives you an idea, using NCREIF data, but Newmark had put this together in one of their reports showing the top 10 markets for the different property types in terms of the performance. So you can see where the top performing industrial markets were, Philadelphia the most, through San Diego on this chart. In terms of urban office, you can see Atlanta was the best, but Charlotte, Seattle, Boston, Dallas, etc. Won't read them all off, but you can see where the best performing CBSAs were, best performing markets by the different property types. Multifamily, Salt Lake City was the best performing. You'll see on a later chart that there's more of an interest in the moving to the Sunbelt areas. This breaks it out by the different property subtypes for apartments. So you can see the high-rise apartments, that's the worst performing. I think it's again because of COVID and concern about more dense spaces, as opposed to the low rise, and the garden was the best performing. So I think in a lot of cases it's a question of, you want to be in less dense living areas or less dense areas of the city, the suburbs versus the CBD, as we'll see when we look at office properties. The cap rates, and now this one kind of surprises me, and I was showing this chart to a group of appraisers. They didn't have a good answer either. Kind of surprises me. We just saw on the previous chart that high-rise apartments were not, they were the ones that were performing the worst, where garden apartments were performing the best. Yet you can buy into garden apartments at a much higher cap rate. It looks like the second digit should have been added on here, so you have to, the going up, the first 4 will be 4%, second 4 will be 4.5%. So you can see we're at like 4.25% maybe for high-rise apartments, but then you're up around 5.5%. Quite a difference. Well, no, about 5%, but still quite a difference for the garden apartments. So if the garden apartments are what's performing well, yet you can buy them at a higher cap rate, I guess that would suggest that maybe those would be the best area to invest in right now. What do you think, Jeff? Does that seem a little bit of a disconnect, that the cap
It
rates are
does,
the
but you
highest
have
for
to
the garden
remember,
apartment?
it's a different buyer pool, and where the high rises, those urban markets have always generally had lower cap rates. So, the garden apartment being in secondary market has a different type of investor profile typically for it. What is interesting to see in all of the charts, though, that there is this flight from the major centers. It used to, most cycles where all the money wanted to pour into New York, LA, San Francisco, and now it's seeing that the opportunity and the liquidity in the secondary markets is sufficient enough to move in that direction, to take advantage of the higher yield.
So we should go to RealNex listings and find some garden apartments for sale.
It seems like there's an opportunity there.
Okay, and then looking at the NOI growth, you again see the NOI growth, even though it's slightly negative, was the best of each of the subcategories for the apartments, with the high rise having the lowest NOI growth. And again, without beating this to death, all else being equal, the more growth you expect, the lower the cap rate you should be willing to pay, because you're going to make up for the income and growth. So I think it seems a little bit of a disconnect, that the cap rates would be the highest for the garden apartment when the growth is better. So we turn to office, as Jeff kind of said. Yeah, it's similar story. It's the suburbs that are doing better relative to the CBD. That wasn't always the case. In fact, I think there's a chart, that Newmark put together in one of their reports that goes back to when we were coming out of the financial crisis, and there it was the urban areas that the capital was flowing into and getting the best returns, but that shifted, as you can see, when we get out here to 2020. It's the suburban areas that are now doing much better than the urban areas. So really a shift in where the capital wants to go and where they see the opportunities. And then when we look at retail, we see that the regional malls, they're at the bottom, super regional malls, both of them are fighting for last place, I guess you could say. But we know what's happened to a lot of the anchor tenants. Then the neighborhood is the best. The very top is the overall NCREIF property index. So that's all the property types combined. So of course, all the retail is below everything else because everything else includes the industrial. But of the retail subtypes, you can see that it's the neighborhood that's the best. But that's your grocery anchored, strip centers, and where your pharmacies are, the CVS's and the Walgreens, and I think that's the only place I've ventured out to recently, wearing my mask. So those are holding up, whereas the regional malls aren't. But we know that Simon Property Group and others are jumping in there and buying up some of the failed tenants, and maybe that now's the time to get into that if you know how to best reposition those properties. But I'm sure that people listening in have more expertise in doing that than I do. The vacancy by the different property subtypes. So now going up is bad, right? So the regional way up there compared to the others. The again, the neighborhood, the lowest in terms of the vacancy rates. And then looking at it by property subtype in terms of the NOI growth for the retail, you can see the NOI growth the lowest for the regional. You really see a similar story once you put all these slides together. The NOI growth the least negative for the neighborhood. Still negative, but as we talked about before, that may be a little deceptive. Some of that money may come back in the renegotiated leases. I know during the last call, Terry Talon was talking about that quite a bit. Looking at some of the other property type returns, look at hotel. Wow, it did recover. If you look at it to the right there, where it's got the quarterly data, but looking at it on an annualized basis, for the year down, 25%. Hard to know when, although it's starting to come back. I suppose if everybody gets, not maybe everybody will, but if enough people get the vaccine and people are starting to travel again for business, hotels certainly could continue to have a recovery. I know groups that I've been talking to lately, they're anxious to start meeting face to face again. They're getting tired of Zoom calls. They want to see each other and head to the bar together. I know Jeff Finn is anxious to get back here to Vegas, right, Jeff? So,
absolutely.
What property sector do you think will perform best in 2021? Is it going to be apartments? I think you could build a case for that, especially if the immigration starts to increase. Immigration really tends to drive demand for apartment properties. Hotels, are they going to have a strong recovery? Industrial, is that just going to continue to outperform everything else with the performance of warehouse? Or is office, people are going to return back to office and that's going to recover? Or retail because it's been oversold? And we'll see. I think I can open this up, Jeff, and see what we got here. Wow. So we have 22%. Yeah, well, it's still coming in. 60% 61% industrial, 62% industrial. Up now back to 60. It's stabilizing.
Still shows
So we
down
got
in,
we got 60% industrial. We've got 23% apartment. That's interesting though. This is what makes a market, right? And we
yeah,
got
absolutely.
some disagreement. There's a group that I was talking to just last week that wants to have derivatives where you can buy. I'm going off on a tangent here, Jeff. You can buy ups or downs based on the different property sectors. Actually, they were asking me. This would be based on using the NCREIF indices that we've been talking about, where you could in effect either buy or sell the index. And they said, okay, we have somebody ready to make a market. It's all set to trade on the OTC. What we don't know is which sector we should start with, because once we launch a sector, it's going to cost us, I forget the number, but like $40,000-$50,000 a month to keep it going. So where do we start? Do we start with apartment? Do we start with industrial? Do we start with office? Do we start with retail?
Interesting.
Now
Right.
that may be a different question than what we have here, right? Because if you're not already in industrial, maybe you'd like to buy the index. If you really think it's going to be apartments that are going to come on strong, maybe to quickly get into apartments, you use the index. So actually,
That's
if
going to be
any,
an interesting instrument, and it gives the ability to hedge, it sounds like, which is an important part, which is not as easy to do
that's right.
currently.
Yeah, that's right. So the idea would be if you're overexposed in a certain area, rather than selling your properties, you would be able to sell the index. It's just like any derivative works,
Yeah.
but
Interesting.
organizations keep trying it for real estate. For some reason, it just hasn't worked. But they keep trying, and maybe this one will. They're now taking the approach of having it available on an over-the-counter basis, thinking maybe family office firms. If the institutional investors don't do it, maybe the family offices will. All right, moving on here. So transactions are back to normal levels, which is good. Now, transactions in this case are properties that have been sold by the institutional investors, but that doesn't mean they're getting out of real estate. That means they're selling and buying other stuff. And what that really means is there's liquidity in the market. If you look at this chart, you can see where it was down in the 2000, 2001 tech bust 9/11 area. Then it went way up to the 200 to 300 level. Then during the financial crisis, it was way down again. Then, transactions, they bounce around, but moving up. But then during COVID, way down, almost to the same level that we had during the financial crisis, but now back up to that kind of normal level of 250 or so transactions every quarter. That's still a small percentage of the database because there's, like I said, about 10,000 properties in the database, and the institutional investors, don't go in and out every year. They hold for 5 to 10 years, but we do like to see transactions in that 200 to 300 level to kind of indicate there's liquidity in the market. If people want to sell, they can sell, and I think that's happening right now. As there is capital available, you can see the RCA that tracks transactions data was down in 2020, but there are signs that the transaction activity, if you broke it out quarterly, you would start to see, I think, some increases.
Yeah, I think we saw, wasn't it, in the second quarter was down maybe 80 or 90%. So for it to be at that year-end level, that shows quite a recovery. The market's been
right. Good point.
extremely resilient.
The market has come back. I know, Jeff, you're talking to a lot of people, and in some cases they're saying I haven't seen a drop at all, or I'm back to where I was. Kind of depends on where you are and what property type you specialize in, but
Absolutely.
there's always money to be made, right?
Yeah, some folks are having record years last year, as you say. If they're doing build-to-suits and industrial, they're as busy as they can be. If they're in that from an investment sale or leasing market as well, from a brokerage side, it just depends on the sector. But
yeah, this chart shows the contributions and then distributions that are made from funds, either distributing money back to investors or investors taking money out of the funds. And we can see the distributions are a little bit more than the contributions, but nothing like we saw 2008, 2009. And as you'll see in a later chart, Doesn't show up quite as much here. It says fundraising slows, but activity is picking up, although you don't quite see it in the third quarter. But I think this was put on there by Nuveen. It's part of the TIAA group, because they're seeing that transactions activity are picking up if you look at the fourth quarter data. And then you see capital raising here. And if we look at the right-hand side, the measure of dry powder by Preqin. Preqin follows investments in real estate funds. And you can see that the amount of dry powder, in other words, capital that's out there, on the sidelines ready to invest, is pretty much at the highest level. A little bit of a dip, that we had due to COVID, but getting back there to the level that we had pre-COVID. So a lot of capital out there available, and I think that's one of the reasons that we have interest rates down and cap rates down. Cap rates, I think, since about 2011 or 12, when I've been doing these webinars for different groups, I say I don't see how cap rates could go down anymore. Because we all remember, if this chart went back further, where cap rates were pretty much always in the 8-9% range. Teaching courses for the Appraisal Institute, we always used a 10% cap rate. Easy to divide by 10%, but cap rates were always in those high levels, and they just keep going down every quarter, and they went down again this quarter. I think part of that because of low interest rates, and low interest rates globally, and you can see the spread between the cap rates and the BAAs, which track cap rates pretty closely. That spread is actually at one of its widest levels again, unless we go back to 2008. We had periods before that where the spread was negative. So there certainly is room for cap rates to drop even more. Don't know if that'll happen, but there are signs and talk now on CNBC and other places of inflation coming back to levels that maybe we'll get up to the Fed's target of 2%. Hard to say, but this was a chart that was put together by LaSalle that shows how the amount of negative yielding debt on a global basis is increasing to the highest level it's been since 2014. So we just have a lot of low interest rate, even negative debt around the world, and that's helping to keep interest rates down. Now, what's going to push interest rates up? I won't try to read off everything that's on here, but the big red portion, this is put together by Oxford Economics, that joined me for the similar webinar that we did for the institutional investors last week. And the point here is all the money being spent due to COVID, all that big red stuff, okay, is by far a lot more than all the money that we spent as a result of the financial crisis, which is the blue part. TARP, that you may remember, and the American Recovery and Reinvestment Act. So just a lot of borrowing. I don't recall what the percent of GNP is, but I think it's at a record level. Our outstanding debt is a percentage of the GNP, and you'd think at some point that's got to result in higher interest rates. But a lot of people argue that we're just going to continue to be in a low interest rate environment. This kind of shows the same thing, where not really, it shows GNP, I'm sorry, or GDP, again from Oxford Economics. This, I think, is pretty optimistic. Look at what they're projecting for the growth in GDP as a result of a lot of the government spending that they project that we're going to have over the next couple of years. And so you see a pretty strong recovery being forecast here, going forward into 21, 22, 23. And I can tell you, I don't have a chart to show you today, but if you look over the history of the NCREIF property index, it's very highly correlated to the GNP and GDP. So if we have this kind of growth in the GDP, that's got to be good for real estate. Again, there'll be winners and losers, but on average, that's going to be very, very optimistic, I think, for commercial real estate. And they do project a slight increase, as you can see here in the federal funds rate, but not big increases, not getting back to the levels that we had 2018. So where will cap rates be by the end of 2021? I know this varies a lot by property type, so think of this more for the institutional real estate, or just whether you think it's going to increase or decrease relative to looking at 4 as your benchmark. So we're currently just over 4%. Do we think they're going to drop further below 4, or kind of stay in this range 4 to 4.5, or even go higher? And we have the results coming in here. So we have a lot saying 4 to 4.5, over 50%, but quite a few. We're at 23, 24% saying it's going to be 26%, saying it's going to be below 4%. So we have seen arguments where it could keep going down further, and we also can build an argument that it's probably going to stay at the same level, or even that it could increase. We have 17% that say it's going to increase. Actually, 11% that say it could be above 5. Shows you kind of the uncertainty that we have right now, because I think you could really see where any of those could happen. Where they
Interesting, the
could go
diversity.
lower. Yeah. I mean, certainly with all the government spending, it's at some point, if inflation comes back, yeah, that's got to push interest rates up, which would push cap rates up. Actually, as I show in this chart here, and with the question, I selected the interest rate and the GDP because that's really the tug of war. Interest rates going up would push cap rates up, but more growth in the economy would, which results in growth in rents and growth in values, would push cap rates down. So which one is going to win? Interest rates going up, or if that's accompanied by inflation that pushes rents up and values up, and real estate has always done well in an inflationary environment, that could keep cap rates the same. So
it seems with all this liquidity in the market, Jeff, now it's got to be pushing still lower before inflation kicks in longer term. There's just too much.
Yeah, and a lot of capital looking for a place to get any kind of yield. So as long as there's a lot of capital out there, that's going to keep rates low. Okay. This just takes a little bit of a global look. NCREIF also works with an organization in Asia and an organization in Europe to do a global index, and that can be broken out by the different countries. The U.S. hasn't recovered as quickly as Asia or Europe, but all of them are recovering, which is good because we just have more of a link, I think, now than ever between what's happening in the U.S. and what's happening in other countries. Just like, financial crisis and COVID and, all these things affect everybody. Can't get away from it. And similarly, industrial is not just performing best in the U.S., it's performing best everywhere, which is the point of this chart. And then finally, I've got some views of some different people on who the winners are going to be and who the losers are going to be. We've talked a lot about this already, and this design where I don't have the answer as to who's right and who's wrong, although there are a lot of, I think, consistent views on the winners and losers. But you can see what's going to be the most negative up to the far left. So here they're saying senior living, although we saw in the NCREIF data that's been holding up, but of course senior living can be higher density, and a lot of the nursing homes really got hurt. So maybe that'll be hurt the most in terms of a property sector. This one has student housing next, although I've seen other people see student housing as coming back strong. Hotels, of course, I don't think we disagree on that one, and malls. Then go to the other end of the spectrum, as we talked about, data centers, industrial, life science, self-storage, medical office, single family. Actually, this is just like an earlier chart, right, where we saw the transactions and what REITs were doing the best. So after a while, you kind of see a similar story in all this. I just had a message pop up. You may be experiencing degraded audio. Do I sound okay, Jeff?
You're still loud and clear. So,
Okay.
all good.
And then this chart by Nuveen, their opinion as to where the tailwinds are and where the headwinds are. So the tailwinds: urban, logistics, life science. In other words, pushing returns up and doing good. Data centers, R&D, suburban, flex, office, and then you move to the far right: department stores, covered malls, so forth. So again, just an opinion on who the winners and who the losers are going to be. So the far right winners: workforce housing. Well, the headwinds, so bad on the far right. So travel and tourism, the physical retail, hospitality, anything that's dense, workforce housing, public transport, big cities, urbanization. But then on the far left, sustainability, healthcare, Sunbelt cities, so forth. Quality of life, areas that offer more quality of life. Then won't read off all these, but another view on kind of where the opportunities are and where the biggest risks are. So opportunities: repriced urban apartments, warehouse, suburban Sunbelt markets, retail net lease, grocery anchored, repriced smaller office that can be retrofitted, and then biggest risks: apartment near term, warehouse that could be affected by increasing supply. Now here are student housing. See, they think that's a risk. We seem to have a big difference of opinion on the student housing. Of course, retail really depends on what the subtype is. I think we looked at this one before. I may have repeated this one. Top 10 markets. And then, but COVID to accelerate the movement to the Sunbelt markets. So you see Austin, Raleigh, Orlando, Dallas, Houston, although wouldn't want to have been in Dallas and Houston over the last week, but Las Vegas, where I'm sitting right now, over on the areas where they projecting a lot more population growth. And then to the far right, Pittsburgh, where I grew up, gets no respect, along with Rodney Dangerfield. We could agree or disagree, but different people have different projections as to what the areas are going to be. They're going to have the most growth, but certainly some arguments for, especially if you can work anywhere, why not go to where there's a higher quality of life in the Sunbelt areas? So this is kind of a general question: where will real estate values be by the end of 21? Maybe correlated with what we think is going to happen to values earlier, but do we think values are going to be significantly lower in general, or returns and values will probably bounce around the current level, or values are going to be significantly higher by the end of 2021? Or maybe you have no idea, because it is hard to tell right now. But our participants have a strong view. That's 75% so far say returns and values are probably going to bounce around the current level. Interesting. So by the end of 2021, this is almost the same as we saw from the NCREIF members in the webinar to them. We do have some that say it's going to be lower, 13%, some that say it's going to be higher, and actually, well, 8% have no idea, which is certainly understandable at this point. I actually thought after the forecast that we saw from Oxford on the GNP growth that there would be more that would think it's going to be significantly higher. although we are just saying by the end of 2021. So maybe if we made this 2022, we'd be back to where we think things are going to be pretty good. I mean, if the vaccine works, if we continue to have the GDP growth, at the same time interest rates stay down, and we get a little bit of inflation, I don't know, what are the headwinds, Jeff, for making that not turn out to be a good story for commercial real estate in 2021 and 22?
It's just the I would say economic growth, but it seems as you've highlighted, there's a lot of pent up demand on all fronts. So I wouldn't expect the economy to slow, or this liquidity to falter. So I would be leaning into that. And maybe it's the word significantly that got the audience to maybe have it
That's true.
so
Yeah.
clustered in B.
That,
I
yeah.
would say the value will continue to grow. Maybe may or may not be significant, but it could be. I mean, yeah, I think there's certainly an argument for lower interest rates to continue, and for cap rates to continue to come down, and with all of stimulus coming for the economy to grow. So again, it just depends on the type, and do people return to work? How do they return to work? What are the implications on the office side, which are maybe a lot of the bigger unknown in the market? How's that going to play out?
Yeah, so some concluding comments here. So Oxford Economics says after a dire 2020, growth in 2021 will be the strongest in 40 years. Of course, we're coming off a pretty, low level, right? We don't have a big bar there to beat, but although, it may not seem like boom times for many, but we know that, COVID has caused some people to do really well and some people not so well. Big worry is the spread of more transmittable coronavirus strains. That, certainly is a concern. Hopefully the vaccines will work against all of them, but we don't know yet with these mutations. They think inflation will rise this year, but not, significant increase. National returns do continue to improve, primarily due to industrial so far, but other property types except retail helping out. Transactions back to normal level, which is good, and cap rates continue to stay at historic low levels. All right, that's my story, and I'm sticking with it.
You got it. And with a minute to spare, we are ready to wrap up. There are a couple of questions. Maybe we can grab one and then call it a day. But let's see.
Pick one you can answer, Jeff.
Yeah. Any thoughts regarding the premise that since there's limited opportunity for rates to decline further and therefore cap rates to follow them, that cap rates will start to increase? So we talked a lot about that, and
yeah, I keep being wrong every quarter, because in looking at historic levels, and I have learned, that things do go in cycles, and at some point it's got to give, right?
But you've got the B, the bonds trending down, and the when you look at that trend line, it's pretty conclusive that it tracks it tightly. So it doesn't
I
seem
guess
like until that turns.
if I had to bet, I'd say we're going to have a slight increase over the next year, just because I think there's going to be pressure on interest rates to go up, and I'm not sure the increased growth will be enough to offset it. And just looking at the history and knowing things do tend to go in cycles. Do you remember, Jeff, when interest rates had gone up to over 10%? We got up to what, 19% for home mortgages, and they said interest rates will never go below 10% again. That's what everybody was saying. Never go below 10%. There was a lifetime
of refis every couple of years as it just long term trended. So Jeff, thank you so much as always for putting this together. Thanks everyone for joining us. We really appreciate your support. If you're a RealNex client, thank you. If you're not, please come check us out. I'd love to show you our latest solution set, as well as our great new 3D virtual reality and video tools that we have to support property marketing and all that goes with the presentation of assets. So thanks again. Hope you all have a great weekend and stay warm. We'll talk to you soon. Bye-bye.
Bye-bye.